welcome to our Invest in India webinar. My name is Marc Ashton. I will be your host for today. By way of background, my background is financial journalism, previously editor at Finweek magazine, ran JSE-listed Moneyweb for a couple of years before it was delisted back in 2016, and I now run an advisory business which looks at a couple of different things, including stakeholder engagement, human capital, and some impact projects in South Africa. Today we've got a really exciting topic, and that is around the opportunity to invest in India. And just before we kicked off today, Ish, who's one of our panelists, and I were just chatting about the shift in global geopolitics and the global economy, and how we are looking at the change from a dominant North America into a multipolar world, where the likes of India are playing an increasingly important role in the global economy, and also in the global politics. And I think, in one of the years where we've had one of the greatest number of elections and shifting in politics, I think this is incredibly topical at the moment. For those who are unable to join immediately but would like a playback, we will be circulating a playback of this. And really, we do encourage all of our delegates to engage with us. We do look forward to the opportunity to have questions. I think we've all had a number of Zoom and Teams meetings. We don't want to be talking at you. We want to be able to engage with you. So thank you all for your time. We look forward to engaging and using this as a catalyst for future discussions. Our first speaker today is Ish Anand. Ish has 32 years of experience in industry and as an entrepreneur across 5 continents. He's worked with several Indian transnational and multinational businesses from inception to leadership roles. As an entrepreneur, he's had 2 successful ventures, including one that went public in 2018. Over the past decade, he's continued to build success stories in the startup domain while also developing his own venture capital portfolio. Ish has a proven track record of growth and consistent financial performance. Recently, he founded the Really Smart Global Advisory, a boutique advisory consulting firm. And Ish, with that, I'm going to hand over to you and allow you to share your story and the opportunity with us.
Thank you very much, Marc, and good morning to my friends in South Africa, and good afternoon to my friends in other parts of the world. Some who are sitting in India, it's good afternoon. South Africa, good morning, and wherever you are, welcome. So firstly, thank you very much, Marc, Craig, and Janine for having us put this together. It's a pleasure to speak with you. So I'm going to share with you, I think Marc has already given you my background, but I work across geographies, across businesses, and I'm based out of India and the Middle East, so I travel quite a bit. But having said that, I think our focus today is what is the India opportunity? What's happening in this part of the world? Myself and Marc spoke very briefly about the shifting focus from what used to be the developed world to the developing South. There is a tremendous movement in terms of markets, in terms of opportunities, in terms of geopolitics, and all this is driving the entire business from an India perspective. What's happening in India? Let me put up a presentation for you. Okay. Marc, are you able to see the presentation?
Your presentation is up, yes.
Absolutely. So invest in India, and from a perspective of the stock markets and fintech is where I am going to look at this particular aspect today. So the emerging markets and India case study, stock markets and fintech. I'm sure all of you over the last few years have heard about the strides that the Indian markets have made in terms of payment systems, penetration of banking and financial services models in the Indian markets. One of the biggest success stories in India has been the UPI. It's called the Unified Payments Interface. This Unified Payments Interface is a mechanism that has given access to even the smallest of rural areas from a payment systems perspective. The UPI has also traveled out of the country. And as of today, I think there is close to about 40-odd countries that have also accepted the UPI payment interface methodology. And Indians traveling in and out of the country are able to make payments through their bank accounts back home in India and through the UPI interface. One of the last countries to sign on the UPI interface was France, while the president, Mr. Macron, was in New Delhi. It's a digital payments interface that gives access to even the smallest or the tiniest of Indian households or geographies, access to banking and financial services systems that give financial inclusion a huge priority. Let's look at what has led to all this and what the Indian ecosystem has achieved in the last 10 to 15 odd years. Some of the key economic indicators are India has become the 5th largest economy in the world. Soon, let's hope by 2030, or the target is 2027, it could become the 3rd largest economy in the world. Now that, by all means, is a huge, huge, huge achievement, where if you really look at it, close to about 70 years ago, we were one of the poorest countries in the world. We're now going to be the 3rd largest economy, and we're very sure that will happen. What has led to all that? Our GDP as of today is about 7.8% year on year. Previous year, it was 8.4. So we're growing at one of the fastest growth rates anywhere in the world. From a foreign trade perspective, our trade deficit is $23.8 billion, was $19.1 billion in April. However, exports are growing. So business, manufacturing, areas which drive economy, areas which drive growth, jobs, are showing positive indicators. Imports grew by 7.7%, whereas exports grew by 9.1%. Our consumer price index, so inflationary trends, are showing very, very positive signs. It was 4.75% year on year. And it's showing the 5th or the 6th, now the 6th consecutive month of decrease in the inflationary trends. Let's look at industrial production. Industrial production has risen 5% year on year. Monetary policy, repo rates have been kept steady at 6.5% for over a year now. Core inflation has been trending lower, and the Reserve Bank of India is likely to cut rates by the end of 2024. Now, what do all these key economic indicators tell us? More jobs, more exports, better production figures, and lower inflationary trends. So the economy is heading in the right direction. Combine that with the fact that we're one of the largest markets anywhere in the world, I think it makes a very, very attractive proposition for any foreign investor to come in and put in their money. The returns are tremendous. The markets are huge. There's a huge young and up-and-coming population. Geopolitically, we're stable. We've just had our elections. We've got a stable government in place. So all the indicators are positive. From a geopolitical perspective, India has been gaining prominence over the last few years. From a technology perspective, India has had a huge amount of upside to showcase to the world. So we are at the right place at the right time, and we encourage foreign investors to come in and look at opportunities. Let's look at what our stock exchanges give us. Our stock exchanges are extremely old. We have something called the BSE index and the NSE index. These are our 2 primary stock exchange indicators in India. Stock exchanges in India have been in existence for over 100 odd years. So if I really look at it, it's the 18th century onward, the East India Company, when they came into India, they actually set up stock exchanges in the country. However, in an established manner, I think stock exchanges from the time we gained our independence have been in the news and have been gaining traction each and every year onwards. As of today, India has 22 regional stock exchanges and 2 major exchanges, which is the BSE and NSE indexes. Our key indicator is called the Nifty 50, NIFTY 50. So it's 50 of the top stocks within the country. And those are key indicators which we can showcase to the rest of the world. The additional advantage over the last few years has been economies like ours thrive on the ecosystem which helps small and medium enterprises. They are extremely critical for all our economies. And India has also set up something called the SME exchange now. So being a small and medium enterprise, you can also go and list on the exchange. And there's a totally separate exchange for small and medium enterprises. Small and medium enterprises tend to find it difficult to raise money. But now, with the introduction of the SME exchange, this is an area that's being looked at extensively. The benchmark that I mentioned to you, Nifty 50 or the Sensex, it's something which represents 30 of the largest and most well-capitalized companies on the Bombay Stock Exchange. This is something that a lot of people who follow the Indian stock markets would have seen. This has changed from the time I made this presentation about a week ago. The Sensex was 75,000. However, as of today, it's gone up to 84,000 plus. So you can see the kind of growth that's happening. And this same Sensex was at 25,000 10 years ago when the current government came into power. So stability, the right kind of growth mechanisms, the right kind of schemes have driven the stock exchanges to their current levels. A graphical representation of how we see the stock exchanges in India as of today. It started off at 25,000 10 years ago, which is at the lower end. And it's now gone up to 84 plus thousand. It even touched 86,000. But if you look at it, an average 84 to 85,000. And that's the kind of growth the country is seeing from a business perspective. Very, very attractive returns for investors from all around the world. Strong manufacturing fundamentals, strong fundamentals from an economic indicator perspective, strong prospects for investors to come in, investor-friendly policies. So it's working out well for an investor. It's working out well for innovation, for growth, for financial systems, etc. So let's look at purely the last 12 months. What's been happening in the last 12 months? So in the last 12 months, what are those indicators that have helped drive our stock markets or our economy in the right direction? I'm sure all of you are aware, defense is always a very large drain on the economy, and countries like ours, which are large in size and geopolitically play a very, very important role, tend to import a lot of our defense equipment at times. And that's a huge, huge drain on the exchequer. What's happened in the last few years, or definitely in the last 12 months, is there's been a boost in India's defense sector, which means India is now producing a lot of the equipment that it consumes, and it's also exporting it. So India is proposing to increase its defense exports 10 times in the next 5 years. You look at any major economy, you look at the US, you look at Russia, you look at China, you look at any of these economies, they are huge exporters of defense equipment. And that is a very, very large part or a component of foreign exchange reserves that they build over the years. Stocks have gained between 3% and 20% in a short time frame. So the rub-off of a huge amount of defense exports has been clearly seen on the stock exchanges. A boost of between 3 and 20% in a short time frame. The government's been focusing on the Make in India environment, or the Make in India program, where self-reliance has a very, very major role to play. We call it Atmanirbhar Bharat in India. Atmanirbhar means self-reliance, essentially self-reliant or Make in India, which means you save a tremendous amount of foreign exchange. You push the manufacturing sector, your economy benefits, and you've got a huge amount of export potential that you're harnessing. Your markets are rebounding because your economic indicators are good. What are those economic indicators? Better than expected GDP growth figures, strong industrial production data, decreased inflation rates, boosted investor confidence, strong corporate earnings. So corporate earnings are supposed to drive markets. If you really look at it, Indian companies were very inward-looking until 10 years ago. Whatever they manufactured, whatever they produced, they wanted to do it just for the Indian markets. Indian goods and services are now being exported all around the world. So that's the difference. And that's rubbing off on the stock markets in a very, very positive manner. Global market sentiment. So global market sentiments have been such that, given the vagaries of geopolitical life, we've seen, the positive impact coming on to India. The US Federal Reserve, which has an impact on rates around the world, has seen a halt in interest rate hikes, which means the inflow of foreign direct investment into India has been far better than expected. The government has given tremendous boost to various initiatives that have spurred industry to do more, not just within the country, but also export. So continuity in the political ecosystem is a huge plus, and we've had that for the last 10 years. And our current government, given its 5-year tenure, we're likely to see it for the next 5 years. So that's a huge plus in terms of attracting investment, in terms of giving stability to markets and to economic policies. The focus on the manufacturing sector has been tremendous. You have to generate jobs in large economies like ours. And that's where there are huge opportunities in India. One has to remember that being one of the largest, not just in terms of population, but in terms of geography, also in terms of size, we present probably the most significant market opportunity any investor can hope for. Let's look at risk of doing business. So this is a slide I thought was very important from an investment perspective. India stands at 58, Russia at 581 in terms of risk. So the risk profiling of countries plays a huge role. So we're less riskier from an investment perspective than China, Germany, United Kingdom, Chile, US, Brazil. We're far, far better from a risk perspective than all these countries. Now, that's something very significant, very important to note. Fintech. Let's talk about fintech. Fintech has driven the Indian economy. It's driven the payment systems, the banking systems in this country to global levels. Some facts that all of you need to keep in mind. India has the highest fintech adoption rate globally at 87%, which is very significant, and it's higher than the global average of 64%. So we are way, way above the global average of 64%. As of December 2023, we had a total of 5.2 billion bank accounts. And those have driven us to a totally different levels. Until and unless you don't give accessibility to the smallest villages, to the smallest towns and cities in countries like ours, you're not going to have a robust financial system. You're not going to have people putting in money in bank accounts. It will all run as a parallel economy. And that is definitely not healthy for any government or any country. India gave the world one of the largest unified digital payments infrastructure. That's what I call the UPI system. This UPI system has gained so much of traction around the world. I have a small YouTube video, which I'll share the link with all of you. Marc, I'll leave the presentation with you. And if anybody wants it, they're most welcome to have a look at it. So UPI has been a huge factor. India is today the world's third largest fintech ecosystem. Again, opens a huge amount of opportunities. India accounted for 46% of all real-time financial transactions in the world. So online transactions in the world, 46% of all real-time transactions. India is expected to have 1.5 trillion market size for the fintech industry by 2025, which is humongous. It shows probably some of the best growth rates in the world. Let's look at digital payments. Digital payments are very popular in Africa. Wallets are very popular in Africa. But have a look at what India has achieved in the digital transaction space. Financial year 2023 up to 11/12/2023, 116 billion transactions in one single year. Those figures are absolutely staggering. From 1 million transactions in 2016, the unified payment interface has crossed its landmark of 10 billion transactions in the year 2024. The unified payment interface, which we call the UPI, recorded the highest ever volume of transactions in May of 2024, which was 14.1 billion in a single month. That's, once again, it shows what the system has been able to achieve. Daily digital transactions on the UPI platform can touch 1 billion transactions a day, which means 30 billion transactions a month by 2025. Once again, these are the things that are driving the Indian economy. Digital payments increased by 76% in transactions and 91% in value. So it's not just the number of transactions. The kind of value that you're seeing coming out of digital transactions is absolutely huge. Data recorded shows that 42% of the people in the country of 1.4 billion people have used digital payments as a mode of payment. This is driving the Indian economy. This is where there's opportunity. This is what is helping us become a global economic superpower. Acceptance of digital payment infrastructure has increased from 170 million touch points to 260 million touch points, which is an increase of 53%, and it's still growing. Let's look at the last piece, which is extremely important, and a summary of what I'd like to present before you. India is developing its own stack. So India is no longer dependent on the rest of the world for its technology. It's developing its own stack. And the India stack is something which is now being shared not just within our country, but also with the global south. So countries accepting UPI, for example, are working with the India stack now. There's a tremendous amount of technological innovation happening in India. Just for your information, India is today the third largest startup ecosystem in the world. Where was it 10 years ago? It was nowhere to be seen. So in the last 10 years, this is the kind of progress we've made. We've got probably if not the largest, probably the second largest internet and smartphone penetration in the world. That's driving Indian economy. That's driving the Indian share markets, the payment systems, because it's giving us accessibility. We've got favorable demographics. We are the most populous country in the world as of today. And because we are the most populous, we have an opportunity. The young population is increasing on a much, much larger basis. That young population presents an opportunity of aspirations. It is telling people that we want to do more. And financial inclusion initiatives. What governments focus on or must remember is that until you don't bring financial inclusion to the smallest of your villages, to the most rural or underdeveloped areas, you're not going to be able to drive your own economy, no matter how much of foreign investment you get. But until your own people don't see financial inclusion come through, nothing is going to move. So financial inclusion, from my perspective, covers all these areas. It gives better access into technology, into overseas investments. It also gives better access to people, not just within the country, but outside, also to invest in our stock markets, to put in money into our own economy. So I think rather than me speak more, I would recommend that, Marc, if you want to do the Q&A now, happy to do that, or do you want to do that later?
Ish, I am cognizant of time, but I'm maybe going to put two questions to you, which have been submitted from the floor or by the Q&A facility, and then we'll move on to Craig's presentation and do a concluding Q&A. Maybe the first question is, I mean, you've obviously given the positive opportunities, the outlook, you've given a lot of the positive factors. What are the potential risks that should be on the radar of anybody thinking about looking at India as an investment destination?
Very good question. So where there is positivity, there's also risk. So we're a large economy, and geopolitically, we're at a very sensitive area. We're in a region which is seeing a huge amount of action. We're close to the South China Seas. We're close to the Middle East, and we're at a very pivotal position between these two areas. Some of the largest shipping lanes in the world, some of the highest amount of trade happens in this area. ASEAN sees some of the highest growth rates in terms of trade that's happening across. So there are risks attached. There are geopolitical risks. I would have said political risks. However, I no longer say that because we have a stable government for the next 5 years. So that rules it out. But in countries like ours, there are inflationary pressures at times. Touch wood, we're going in the right direction there. We have to keep our imports under check, and we have to keep looking at exports. We've got to keep looking at generating additional jobs. And the most critical piece that I feel that we need to look at is we need to innovate within our country. If we innovate within our country, I think a lot of the factors that may be risks will get mitigated. And we're seeing a lot of that. We're seeing increasing number of patents being registered within this country. And that's positive indication. When you don't have patents, when you're only looking at importing technology and just using your country as a manufacturing base, that puts things into risk at times. We've seen that decrease over the years. We've seen a tremendous amount of innovation, and that's where I see positive things happening.
Excellent. Thank you, Ish. With that, I'm going to now hand over to our second speaker. Our second speaker is Craig Beney. Craig is the founding partner and CEO of Helical Capital Partners. That's HCP. HCP is a sustainability-focused private equity company advising on equity and debt raising for related transactions and fundraising for sustainability investment mandates. HCP also provides reporting and administrative abilities for these transactions and funds, and has previously had an affiliation with the Partners Group, a Swiss-based publicly listed JSE-listed private markets company with 125 billion in assets under management. HCP act as principals on a conduit to the international private funds for the South African market. Craig, with that, I'm going to hand over to you.
Thanks, Mark. And hello to everyone. And Ish, thanks very much for your presentation. I'm hoping mine dovetails with yours. My focus is on the private markets and particularly unlisted companies. And I'll talk to the Indian economy from that point of view. Just as a title slide, it's important to recognize that India has become on the radar of, some of the biggest investors in the world, including Warren Buffett, of course. And there's a lot of interest from outside of that in terms of international banks, international private equity, etc. And I'll take you through as to why that has occurred. And we can debate that as well and talk to it. Just a little bit about my background. Mark has given an indication in terms of my experience. I've been involved in private equity and venture capital for over 15 years and in financial services for over 30. Helical itself is a license with the FSCA, and I've been involved with the SAFCA board as a member, and I've been involved in their subcommittees and still am involved. And for the privilege, I'm also chairperson of the SAFCA Awards Committee. So I've got deeply ingrained feel and want for the success of private equity, mainly because it is a job creator, more so than necessarily listed or government in that respect. And you'll probably see that in terms of government in India, you will see a decrease. And although we haven't necessarily spoken to it in this slide, you'll see government has been a decreased employer of people within India. The real big story ultimately is what happens to the middle income group. And is that growing? Because from a pure private equity perspective, and it will also impact on the listed companies as well, the kind of generator of GDP growth ultimately is the growth of the middle income class. The middle income class is ultimately the biggest consumer spender, the biggest user of consumer, fintech, education, healthcare. They subscribe for private healthcare. That they go to government schools where they can get the best possible education for the children, etc. They're deeply ingrained in the growth of the economy, much more so than obviously your ultra wealthy. And we'll talk a little bit to the poorer parts of the population within India and how they also are migrating through that into the lower middle class. And it's probably the success story actually of India, is that move from lower income to lower middle income. I'll talk a little bit about the the per capita income growth, and that's fundamental in terms of growing the middle class and in terms of growing the consumer base within India. It's almost a threefold increase, actually, to be honest, within 15 years, which is tremendous. And I'll talk a little bit about whether it's domestic-led or internationally led. In terms of overall unemployment and labor engagement, all we see is more and more positive outcomes, lower unemployment rates, and bigger engagement of the labor force. This is increasing across India and is different in different states. And we'll talk about the fact that you have to take into the different circumstances and the different characteristics and dynamics of each state when investing. This is important to reflect the kind of movement of the poorest households out of lower income and into middle income. One is greater access to banking and access to electricity. This has been seen to be greatly enhanced, particularly since 2015. It was affected by the pandemic, and we'll come back to it in terms of the post-pandemic boom that actually India is now experiencing, and whether that's hot, cold, or whether it's actually on boiling point. We also see that ultimately the food production in India is growing, the food imports are decreasing, mortality rates are decreasing. All this lends to the fact that there's a growing domestic demand in the country. And that ultimately is leading to the growth in to the GDP growth story. So to emphasize, India is not an export story. South Africa does tend to be sometimes an export story and not a domestic growth story. And I will make comparisons between India and South Africa during the presentation, because the fundamental reasons is we find ourselves in similar circumstances in terms of being an emerging country, and ultimately in terms of what infrastructure gap is, etc. But the big difference ultimately is India's conquering these, where South Africa is still lagging significantly behind its requirements in terms of domestic growth. So in India, we've got strong domestic growth. So it's ultimately a domestic growth story. This leads to long-term sustainability for investment. So this is not about going into the market, selling, getting out of the market, going to find another market to invest in, etc. And this ultimately leads to longevity of investments. And particularly this leads to the potential of private markets investments, because there's a longevity in mind when it comes to private equity investment. There's a very large, young and educated demographic in India. This is then provide a very strong consumer base going forward, and certainly is providing extremely good workforce also. Just as an aside, I think right in the beginning, I put a quote in terms of Bill Gates, is that he would only hire tech engineers from the Indian Institute of Technology. And the reason why that is significant, and when you talk to it, is that the strength of the education system, and maybe it's currently tech focused, but it will change. It has been a kind of a tech boom in the past, but I'll talk to the industrial sector and how that is increasing as well. But ultimately, there's 1 million engineers that are graduating each year in India. That's an astounding number. And ultimately is one of the reasons why there's been such a growth in India. Together with that, obviously, not everyone gets a job that they would love and desire. So the entrepreneurship and the innovation within the startup industry within India is huge. And you see venture capital providing a much ability for the venture capital companies to grow. And there are exits to the private equity industry. And additionally, there are exits to the SME exchange, which was talked about a little bit earlier. In terms of it touching the mainstream financial markets, we always want to make sure that an emerging country is not isolated in terms of what they're doing, that there's some broad acceptance of what their policies are and what they're trying to do within their country. And I think one of the key aspects of that is how they're included into international indices, etc. JP Morgan has recently added India Debt, the Emerging Market Index. That was at the end of June. And this is crucial because it actually leads to greater inflows into India and drives down the cost of borrowing. So once again, it's another impetus to the growth story. India's emerging market does provide better value opportunities than developed worlds in terms of unlisted companies and purchasing of it, mainly because it is an emerging country, so that the multiples are lower. And it's very important to find fund managers that can target those multiples which are lower and can lead to a bigger uplift in terms of investment returns. One of the key aspects that I discovered recently on a trip to India is that the Indian regulators are extremely active in engaging with the European and US counterparts. And this is to ensure that any concerns that are raised or barriers are addressed. This is kind of a Modi kind of special in terms of making sure that India is business friendly and it's open for business. Real assets. So what is it? I mean, compared to purchasing listed shares or listed debt instruments, ultimately you are actually investing in real assets in the sense of whether it's into technology, infrastructure, logistics, healthcare, etc. So you can touch and feel the asset, as compared to a listed company where you buying a share. So that money is not going into the economy itself. It's actually displacing currently money that's in the market, and you're buying someone else's current investment. Whereas if you invest in real assets, it's your investment money and it goes into those particular assets. I think it's very important to see that the PE and VC industry has grown tremendously, but the tipping point seems to be ultimately around about 2015, when there was a significant growth in exits with new class of investors, mostly international pension funds, sovereign wealth funds, etc., providing new pools of capital. This was important because ultimately before then that the exits were actually quite reduced and subdued. And there was a concern around about corporate governance and a lack of a strong ecosystem. Those aspects have disappeared in the last 10 years. Currently, the Indian Private Equity Venture Capital Association has listed 344 funds that are currently members of the association, and the funds are kind of the members rather than fund managers. So there's a vast breadth of funds within India that people can invest into in terms of private equity funds and venture capital funds. When I was there in November 2023, and I was lucky enough to meet the CEO of IFCA, as well as the National Investment and Infrastructure Fund, it was noticeable that the problems facing South Africa and India are not dissimilar. Infrastructure gap is probably the most prevalent. In addition to that, across education, healthcare, industrialization, as I've said, has increased, I think, from 16% to about 21% of GDP, where we've had a reverse in South Africa in the last 10 years. And therefore, that is a reflection of the good policies that are being introduced by the Indian government. The activity within the private equity space is quite amazing. There are first-time and follow funds being closed quarterly. And in addition to that, you know, where you need to invest is in follow funds where you can actually look at a good track record and is niche in terms of its sector approach. Therefore, they can buy at a lower multiples than other fund managers. I just want to showcase one particular fund manager, and it's only because I kind of met them and kind of on a chemical level kind of really gelled with them. They are homegrown. They've been going for over 15 years. They are very much an early stage startup. So this is not something that you would only put money into. You would obviously look across the stages of private equity. But ultimately, they have built a very strong ecosystem. And once again, I've talked a little bit earlier that prior to 2015, ecosystems were pretty small and actually not very robust. And it was only subsequently 2015 that uplifted. They are headquartered in Mumbai and have presence across most of the states in India. Now, that is quite an achievement because the number of states obviously in India are quite significant, but they've managed to create a presence across those states, whether it's through affiliations or with joint ventures, etc. But they've become quite aware that they need to have some presence in order to understand the different market dynamics within those states. They have invested in over 176 companies, and over time, if you added up all the combined value of those portfolio companies, it comes to over 3 billion over the different life cycles. So that's extremely important from the sense that they've been there and done that. They've got the track record, etc. And additionally, most importantly, they've exited and have provided returns to investors. Just on the fund of funds, I'm briefly touching on it because there's multiple ways that you can potentially enter the real assets market within India. Fund of funds is one of them. And its reason is that ultimately the fund manager, in terms of the fund of funds, is able to identify those private equity fund managers that are best placed to provide the best return to investors. It's the responsibility of the manager to turn stone over stone to make sure that he's done everything he can to identify the best possible managers. And in addition to that, it's very important that you build relationship with these fund managers. It shouldn't be a once-off. It should be that you want to invest in their second fund and their third fund, mainly because you'll discover in private equities, the money comes back to you. And as the money comes back to you and the returns that you get, you kind of want to reinvest with the people who have given you those returns. So you need to build strong relationships. I suppose the most critical part, which is more part of the unlisted company rather than listed, is because you get close to the company, you need to develop real trust and integrity and make sure that you're getting consistent reporting out of your fund managers. This is ensure that you have very high ethical standards within your investments, etc. The due diligence of the fund manager still has to be extremely robust, and the quality of the evaluations is a firm litmus test in that regard. The funds of funds we're talking about would generally be would be a fund that is based in Mauritius. Mauritius is a robust financial market. It has been there for over 20 years in terms of what it's trying to do. Most of the DFI, so Indian DFI, has gone through Mauritius in the last 20 years. It has been on the grey list in terms of the OECD Financial Action Task Force grey list. This was in February 2020, but it took them 18 months to come off it, which really reflects the seriousness of their approach to making Mauritius a strong financial services center. South Africa, in comparison, is probably going to take about 2 years to come off the grey list. Admittedly, we have a very different market and very different economy, and the size-wise, but it is shown that ultimately Mauritius is a strong center and will carry on being a very a conduit of Indian DFI into India itself. Mark, that's it for me from a presentation perspective. I'm hoping I've covered a lot of the aspects which make India a very attractive destination in terms of private equity investment.
Excellent. Thanks, Craig. Maybe just to ask a question that I think is probably on the lips of almost everybody who is looking. Obviously, it's a compelling story. We love the idea that India is playing an increasingly dominant role from an economic perspective. But I mean, what are the kind of most, firstly, two-part question, I guess. What are the most common questions that managers are asking you when they look at you and say, what's your experience in India? And then secondly, I guess ticket size is probably quite an important one. I mean, obviously, if you're very familiar with the South African market, you've got some sense of what that investment ticket size looks like. Some thoughts around what people are typically making from an investment perspective. Maybe those two questions to get started.
Yeah, so I think what investors are looking for, and I think that's ultimately what the question is. Ultimately, the investors are looking for a solid return, and this is somewhere in terms of dollar returns, with somewhere between 15 and 18%, particularly in a fund of funds, and those are being achieved. They are being achieved in developed markets as well. So India, in terms of its growth story, is likely to be as comparative, and additionally should be getting towards the 20% in dollar return after costs. It is cyclical in some respects. In other words, when the listed markets do suffer a bit of a downturn, the private markets does as well, but it's not as volatile as the listed markets. And additionally to that is that it's shown to outperform the listed markets over 20, 30 years. So ultimately is once again, is that it's a long-term investment, and India is perfectly placed in terms of sustainability of that cycle that we're looking for, particularly in private equity. In terms of recession, I think even Morgan Stanley recently came out and looked at the possibility of countries going into recession in the next 3 years. And my memory was right. I think UK was around about 30 to 40%. And even the US was somewhere around 15 to 20%, but India was listed at 0% of chance of going into recession. So that's once again an extremely important part of what we're looking for in terms of consistent returns. In terms of investor size, in terms of getting into the market, I think it really depends on whether you are an institution or you are an individual. We tend to try and cater for both. And generally, as we will accept a minimum of about $200,000 for a fund of funds from an individual, up to a maximum of about $2 million. Institution is kind of really from the $2 to about $10 million that we would look at. And then this is pretty in order to get to the kind of critical mass that you need, that allows you to actually sit on the advisory boards of the different funds and ultimately be a part of the discussions with the fund manager, etc. one nice thing about also the unlisted market compared to listed is you get a market update, you get a market update once a quarter on the listed market, but it's put out in terms of the stock exchange news. Whereas we can actually pick up the phone to the fund managers and inquire about the performance inter-quarter as well. Plus, we get very granular details about the underlying investments, how it's performing, etc. So once again, obviously I'm talking to my own sector, but it is very much a more transparent sector in terms of valuations and etc. and outcomes.
Thanks, Craig. There's a question here. I don't know whether you feel comfortable answering it or not, but it has come by the Q&A facility. Craig, what are your thoughts on the Satrix MSCI India fund as a means of getting exposure to the Indian market? Are there other effective ways to invest in India from South Africa without having to establish a presence in India directly, particularly for smaller retail investors? I mean, I'm cognizant, obviously, you think around issues like advice, etc. But any comments that you'd like to make around that question?
Yeah, so I think there is multiple ways of accessing the market in India. The Satrix is clearly one of them. And just bear in mind that the reason they put it there is that the JSE is looking to attract, obviously, more and more investor money onto their platforms. I don't see any issue with that as a way to do it. It will obviously go into listed companies within India. I don't know of any reason why any individuals need to establish a presence in India to invest. You could actually do it through brokers internationally, to be honest, and buy and sell shares. But as a South African investor with, using rands to invest in India, it's certainly a doable way of doing it. And, not without giving advice, which I don't think I am, is that ultimately, once again, you've got an economy that's going to be the third largest economy by 2030. And, bypassing Germany and Japan, other than picking absolute dogs somehow, but the Satrix won't, because it'll probably be exposed to the Nifty 50. Therefore, it's I would think it's an opportunity that South African investors should look at. It is a different market. It's therefore diversification from your domestic market. It does allow you to decrease your overall risk and potentially look for better returns. So without commenting directly on the underlying investments that Satrix has, overall as an objective is what investors should be looking at in terms of their overall portfolio.
Excellent. Thank you, Craig. I am cognizant of time, but I do have one additional question here that's come through for Ish. Ish, what are the best practical options or avenues for South African smaller scale investors or family offices to start investing in India? So far, the ease of doing business has been incredibly challenging, particularly when it comes to setting up bank accounts, dealing with taxes, and opening investment accounts like Zeroda. How can these hurdles be navigated more efficiently? Ish, any views on that?
Sure. So I'll tell you where the problem lies. Mechanisms are available both within the country and outside. However, there's a lack of information. People don't really know what the right way to do it is. So the answer is to actually set up ways and means, or set up an information desk, which will be able to dispense information and set up channels within India as well as outside that can help facilitate smaller investors to come into India. India today has several opportunities by way of smaller funds, bank accounts, online investment opportunities, online platforms that give you access into the Indian investment scenario. So legally, there are options. There are options directly into India. There are options through various countries that set up investment structures for India. So you can do it either individually, or you can do it collectively as a group, or you can do it through a larger fund sort of a structure. So I think it's a very lengthy topic. The short one-line answer would be yes, there are opportunities. Opening up a bank account is possible, but not as an individual. You can open it up as an organization or as a company. And I think that is only fair if you're making investments. You would do it on a certain scale. You would do it conforming to certain rules and regulations or laws, and that is possible. So anybody who really wants to look at it, people like us are very happy to come out there and give you the right kind of advice. We can help you, put you through to the right people, and those are very, very clear legal channels that you must use while making investments into a country like India. Sorry, you're on mute, Marc.
Thank you, Ish. I'm cognizant that we're about to hit the 1 hour mark. So in closing, I'm going to extend a couple of thank yous. Firstly, to all the delegates who have invested the last hour of their time to join us today. And for those that will join us via the playback facility later, they always say time is one of your most valuable commodities. So thank you very much for investing your time. To our two speakers, Ish and Craig, thank you. Hopefully this is the start of an ongoing engagements with us and the other stakeholders. To our co-sponsors, Moodley Attorneys Incorporated, to Jin and his team, your partnership and your enthusiasm for the Africa-India story is hard to rival. So if you would like to connect with Jin and his team, these contact details will be shared. And then lastly, to the Consul General for being a voice behind driving this this partnership and this discussion. It is important that we establish these bilateral trade agreements and opportunities. And for us, it really has been an encouraging start to this discussion. With that, I'm going to wrap up. I appreciate all your time, and we will once again share this facility with you. Thank you, everybody.
Thank you, Marc. Thank you, Craig, and thank you, everybody who's attending.